Welcome back. In this week's Economic Week Ahead, all eyes are set on the global economic conditions as crucial PMI data for the manufacturing and services sectors will be released. At the same time, the upcoming Fed's meeting in September is expected to be heavily influenced by the monthly employment report. Joining us for a look ahead is Joshua Mahony, Chief Market Analyst at Scope Markets. Thank you so much for your time, Joshua. Indeed a very big month. And of course, that's as lots of economic data is coming through, quite a number of central bank decisions, particularly the Fed, with that meeting taking place mid-month. Of course, ahead of that, we did have the PCE inflation that rose in July, and we're also getting the jobs report on Friday. So just talk to me, with all that amid the political interference that is targeted at the Fed. So what is your gauge of market sentiment towards what the Fed could do this month?
Yeah, well, I mean, look, we've just exited the phase where there's a big focus on earnings. Now we're turning towards the economic data and the Federal Reserve in particular in a month where, by and large, markets are now pricing in a very high chance that we do see a rate cut. And ultimately, the Jackson Hole appearance from Jay Powell signaled as much. But this week is all about really reiterating the weakness within the jobs report. Of course, a month ago, we saw not only a big miss on the payrolls number, but 258,000 jobs written off the prior 2 months in terms of revisions. Bearing in mind now the past 6 payrolls figures have all been revised down. So we're expecting to see weak numbers this time around as well in terms of the jobs report. But does that mean that that's actually going to get revised down as well? So certainly right now there's a big theme around weak jobs data that's expected across the board, whether it's the JOLTS numbers, the ADP, the headline payrolls figures, all expected to weaken. And the narrative, given the core PCE price index coming in relatively under control, means that the Federal Reserve are likely to ease this time around. But how much will they ease further on into the back of the year, and in particular next year, given the fact that we are seeing it increasingly Trump putting pressure on the Federal Reserve and potentially molding it in his own image?
We'll talk about economic dynamics. We also have those in the EU. Lots of data coming out of that region this week. Unemployment figures and inflation print and GDP numbers. From what lens will you be looking at those figures?
I mean, it's an interesting point in time, right? We've just wrapped up a month where we saw major outperformance for some markets compared to the US. The underperformance, by and large, came from Europe, and part of it comes down to the fact that we're now roughly a week away from a vote of no confidence in France, where we could suddenly see the political landscape turned on its head. And at the same time, you're questioning exactly what the sort of knock-on implications are from the trade relations with the US. Of course, they have a deal, but it means tariffs. What does that mean for US exporters? We've got infrastructure spending alike in Europe, and that has been lifting stocks for recent months. This week, like I said, well, like you said, inflation data coming out. By and large, inflation's under control. But the question mark is, how much do the ECB feel like they need to continue to help bolster the economy right now?
Yeah. And actually, I mean, as much as we're now moving away from earnings, there are still quite a few earnings that we are digesting. And Alibaba getting a lift from investors after they released their results for the quarter ended June. What did you take out from that? And actually seeing that Alibaba has been having quite a run.
Yeah, I mean, up 19%, and I would probably lay that at the doorstep of Nvidia, which is down heavily today, because it was all about the AI revenue, triple-digit gains for the 8th consecutive quarter. And certainly those AI-related gains are growing. So, of course, we're at a point in time where we've seen incredible gains for US companies associated with the AI trade. And now you see this massive rise in terms of revenues coming from Chinese stocks on the AI side. Of course, Nvidia now selling pretty much zero chips to China. So if that continues to play out, do Chinese firms really lean heavily on their own tech companies? And all of a sudden, Chinese tech starts to look a lot more interesting from an investor standpoint.
What about Salesforce? Because as we're talking about companies in the kind of tech software space that also coming out with quarter 2 earnings, what has been the reading there?
Yeah, I mean, look, as with many of these big tech companies, you're always coming into it thinking, what's the AI trade here? But a
Yeah.
lot of the time, it comes down to something like cloud, right? That's such huge revenue sources for many of these different companies. So cloud's probably going to be the big one. But then at the same time, we're looking at this sort of agents model, and of course, when you try to look forward and say, 5 years down the line, we're going to have robots taking all our jobs. It's for a lot of the sort of sales side of things, it's all going to come down to AI agents and Salesforce at the front end of that. So seeing exactly how the growth of that business has been working as they try to bring those benefits to their consumers and customers, that's going to be really key.
Let's go on back to China. Quite an interesting one, because on the opposite side of the spectrum, as we're talking about Alibaba's shares surging, we did see the shares of BYD plummeting about 8% on the back of their earnings. This is quite interesting that there seems to be a pullback now in kind of investor sentiment with this company, because it has been seen as the winner against Tesla. But is there just generally maybe concerns on that kind of EV sector at this point, and particularly in terms of this price war that's happening?
I mean, the price war really is key to it, right? Their margins have just been decimated, but ultimately they were sort of built as a company that was made to operate under very low pricing conditions, and that's how they were so competitive worldwide and really have been pushing Tesla heavily. Now, Tesla, we've only just heard that they've been particularly weak in Europe. BYD's actually been expanding massively in Europe. There's still 80% of the business coming out of China, but now we've seen this sort of massive underperformance in terms of profitability. Revenues continuing to rise, but really margin squeezing. The Chinese government has been saying they want to see an end of this price war, but ultimately the sort of structure of that industry in China has been built around overcapacity, overproduction, and flooding the global market. It's all right for consumers where you're getting really high quality products at very cheap prices, but soon enough you get into trouble where you've got huge amounts of cars just sitting there needing to be sold off at very small margins, and soon enough you see the sort of underlying metrics for the companies sort of underperforming as a result.
Yeah, I mean, just as we wrap up the conversation and sticking with China, because we did get a PMI reading for China coming from Rating Dog that's showing manufacturing activity swinging into expansionary territory in August. Can we be optimistic and call this China's resilience against tariffs, or is it too early?
Yeah, we sort of saw a tick higher in terms of both manufacturing and services side of the PMIs. We saw some strength in terms of oil prices this morning as a result. It gives a little bit of a lift in terms of this idea that we're moving into a phase where it's going to be dominated by global growth and strength. We don't necessarily know that will be the case. I mean, look, it feels like it's been a very drawn out process, this whole recovery for China. And, we're talking about disinflation, we're talking about PMIs that have been in contraction territory for a long time. So they're sort of nibbling into something that looks a bit interesting, but it's still probably too early to say we're in some sort of major boom that's going to start really spurring a massive rise in terms of commodity markets and alike.
All right. Well, we do have to end the conversation there, Joshua, but thank you so much for giving us insight into the things that we will be sifting through this week. That was Joshua Mahony, Chief Market Analyst at Scope Markets, with the Global Economic Week ahead.